There is another product which is really gearing up as on today, that is called as insurance. Friends, you are all aware that insurance has become the need of the day. In India, we have still 75 to 80% of the population untapped as far as insurance is concerned. Now, why insurance is important? What are the features of insurance? What is the advantage of the insurance business for the banks? Because we are basically trying to understand how insurance product, which is being used as a third party product for cross selling by the banks, how it can make a huge difference in the income, in the revenue, in the profitability of a bank. So let us first understand what insurance is all about. Insurance, as we all know, it is basically a protection. Now, what protection are we talking about? Friends, it's a contract to pay a compensation in certain eventualities. Now, what are the eventualities that can take place? It can be death, fire, theft, motor accident, etc. So, we can have any eventuality that can take place, and if I need a compensation, it can be done through the insurance, right? But then for that, to have insurance done, to have an agreement, a contract signed for insurance, we need to pay a premium. So what happens is, the person who is trying to cover himself or protect himself from such eventualities, he needs to pay a premium to the insurance company, and in return, he gets the protection, right? So what happens is, the premiums are so calculated that on an average, in total, they are sufficient to pay the compensation for the policy holders, who will make a claim together with a margin to cover the administration cost and profits, because as we all know, there is nothing called as free lunch. So when insurance companies are doing the business of insurance, they are also craving to make good profit out of this business, right? But then how are they going to make profit? It's all going to come from the premium. So what happens is, when we talk about insurance, there are various category of individuals who are looking out for protecting some asset, right? It can be a life or a non-life asset. So they are trying to protect these assets out from some eventualities. Now, when they want to protect themselves, what they do is, they are going to pay certain premium. As I said, they are going to pay premium to the insurance company. So premiums that are paid by these insured, right, who are going to pay the premium to this insurance company. Now, again, it is like a pool. So the premiums are going to be pooled together by the insurance company, and there is always a probability of a claim to come in. So the probability, let's say it is 10%. So out of the total funds that are collected, the probability is 10% of the people are going to actually claim because of certain eventualities, right? So when there is a claim, the funds which are available in this pool, the premiums which have been accumulated together, are going to be used to settle these claims, right? And over and above that, the insurance company is also going to check that whether they are able to cover the administrative cost and their profits, right? So the premiums are structured, premiums are calculated in such a manner that they are able to cover the claims that might come in and the administration cost and profits for the company. What are the characteristics of insurance? It is risk and uncertainty are incidental to life. Man may meet untimely death. So death is something which is uncertain. So that is a basic risk which every individual carries with him, right? So we never know that when that uncertainty, when that untimely death can happen to us. So in order to protect that uncertainty, that risk, we always see to it that we get into some insurance. He may suffer from some accident. There might be some destruction of his property. There can be a fire, a flood, an earthquake, or certain other natural calamities that can take place. So there is always a risk factor which is associated with the life as well as the non-life assets. Whenever there is an uncertainty, there is a risk as well as an insecurity. Now friends, if I am say I am the bread earner for the family and everyone is dependent, the whole family is dependent on me, I will always feel the risk, I will always have the exposure of risk of me facing an untimely death. Now, if I face an untimely death, what will happen is the repercussions are going to be bad for my dependents. Those the people who are dependent on me are going to face the consequences, right? Because I am the bread earner of the family, they will not have any source of income if I am not available. So, it's such risk, the risk which I am carrying, I would like to protect it all the time. So, whenever there is an uncertainty, there is a risk as well as insecurity. It is to provide against risk and insecurity that insurance came into being. So, what was the basic objective of coming up with an insurance? It is just to cover this insecurity, to cover the risk which every individual is exposed to. Now, the main principles underlying insurance is pooling of risk. As I said, every individual, right, whether it is life or non-life, every individual is carrying certain portion of risk. Now, all these individuals who have the risk are going to come together. They are going to pool up all the risks. So, the pooling of the risk is going to take place, and they are going to compensate through premium. So, they are going to pay a premium to get the compensation or to get the protection, and on that basis the insurance will take place. It is thus a cooperative device to spread the loss caused by a risk, which is covered by insurance. As I said earlier, the pool is accumulated, the pool is developed with all the risk exposures which are there. Whoever wants to cover their risk, they are going to contribute to this pool, and this pool is going to be used to settle the claims in case of any eventualities taking place. So, who are also exposed to the same risk and themselves against that risk. So, they are likely to protect risk. Now, what is the contract of insurance, friends? The contract of insurance is nothing but a contract by which a person, in consideration of a sum of money, that is the premium, undertakes to make good the loss of another against a specific risk. So, fire or death or flood or an earthquake or any other natural calamity that takes place. So, such losses, the losses that might occur on account of these eventualities will be taken care through this insurance contract, right, friends? So, the compensation will come to him on the happening of a specified event. So, any event that happens, whether it is accident, death, fire, any such natural calamity that happens will be taken care by the insurance company, and for that we need to pay them a premium. Now, there are two parties to the contract. They are the insurer and the insured. The person undertakes the risk is called the insurer, the assurer or the underwriter. So, the insurance company in this case is going to be the insurer. Why? Because they are giving a comfort level, they are giving the assurity, they are underwriting that in case of any eventualities, they are going to compensate for the losses that might occur. Now, who is insured? The insured is a person whose losses is to make good is called the insured or the assured. So, the person whose losses are going to be taken care of is said to be the insured. What is the premium? The premium is the consideration for which the insurer undertakes to indemnify the assured against the risk, right? So, premium is nothing but the compensation which the insured has to pay to the insurer. What do you mean by a policy? Now, friends, when I say yes, there are two parties to the contract, that is the insured and the insurer, then there is a premium which is levied by the insurance company to the insured. There is a policy. There is always a insurance policy that is signed. That it is nothing but a contract which is signed between the two. Now, what is that policy? The policy is nothing but an instrument in which the contract of insurance is generally embodied, right? So, policy is the instrument, is a document which talks about the contract that has been taken place between the insured and the insurer. The policy is not the contract, it is the evidence of the contract. So, it gives the evidence, it gives the proof that yes, such a such loss or such eventuality is being protected, right, by the insurance company. So what do you mean by the subject matter? Now subject matter can be anything, right, which I would like to protect. Now I would like to protect what? It can be the life, it can be a property, right. So a thing or a property which is insured is called a subject matter, right. It is called a subject matter of insurance, and the interest of the assured in the subject matter is called the insurable interest. So I have certain, let's say I have a property, I have some stock with me, and I am having the concern that if I lose that security, if I lose that property, I am going to incur a huge loss, right. So if I have to protect that security, I should have some insurable interest in that particular property. Otherwise, it doesn't make sense for me to take a insurance policy. So if there is a subject matter, let's say the subject matter is a piece of land, right, for the farmer, for the cultivator, that land is something wherein which is going to help him to earn a living. And if he is concerned about any eventuality, any natural calamities that are taking place on the piece of land, he would like to protect that eventuality, right. He will like to protect against such eventualities. So when he is going to protect it, there has to be an insurable interest in that property. Okay. Now what are the perils insured against? Now what are the perils, friends? That is which insured against is the loss arising from uncertain events or casualties, that is destruction of or damage or to the property, or the death of death or disablement of a person, and these are called perils insured against. So as I said earlier, any perils that will cause a loss to the property, right, any perils that are going to create a loss to the property are said to be the perils, and that is what is to be insured against. Okay. Now insurance as a contract is governed by the same general principles of law of contract. So it is covered under the contract law also. It comes into the existence by the process of offer in the form of proposal, right. The proposal, who is going to make the proposal, friends? The proposal is going to come from the person who would like to protect his property, right, who would like to protect from against the perils, the property which he would like to insure. He is the person who is going to give an, or he is going to give an offer. So offer will come from the proposer, and then if it is accepted by the insurance company after due diligence, after having a cross check done, if the insurance company accepts that offer, a contract of insurance takes place, or the contract comes to an existence. The proposal is made by one party, that is, as I said, it can be the assured or the insured who would like to safeguard on the perils, to the other party, that is the insurer, assurer, or the underwriter, that is the insurance company, for insurance against some losses that should occur on the happening of an uncertain event within a limited time. So there is a time frame. During that time frame only the protection will be given by the insurer to the insured, right. So one thing which we need to know is there has to be a specific time period for during which the loss is the perils are insured, right. So on the happening of any uncertain event during that particular time period, the insurer is going to protect the insured. The object of contract must be lawful. There has to be a lawful consideration for the contract. Now there are various kinds of insurance that are running in the market. What are they? Firstly, the most important, the most outgoing kind of insurance is life insurance. As we all know today, every individual would like to insure his life. Okay. In this case, what happens is certain fixed amount becomes payable on the death of the assured or on the expiry of a certain fixed period, whichever is earlier. So either it is the term, let's say I have protected my life for a period of 25 years. So during that 25 years, if anything goes wrong with me, the insurance company or the underwriter or the insurer is going to compensate. He becomes payable on the death or death of the assured, right. Now there is another category of insurance which is fire insurance. Now what fire insurance does is, it tries to cover the losses that are caused by fire. So any loss to the property, any asset that is caused on account of fire comes under fire insurance. There is third category of insurance, which is marine insurance. Now what is marine insurance, friends? It covers all the marine losses. So anything that is taking place or any natural calamity or any event that occurs on account of marine losses is covered under marine insurance. So it is the losses incidental to marine adventure. So anything that is marine will be covered under marine insurance. Now there is fourth type of insurance, which is personal accident insurance. So in case of the amount payable is a compensation for any personal injury caused to the assured, right? So if I face any accident, if I undergo any accident, then the insurance that will take care of such accident is called as personal accident insurance. Then there is health insurance, which is becoming an important form of insurance today, and it provides benefit of medical expenses. So if I incur any hospitalization charges, any expenses I incur on medical grounds, all those will be reimbursed through this health insurance. Then there is another category which is called as property insurance. Property insurance takes various forms like theft or burglary insurance, fire insurance, liability insurance. So all these come under the category of property insurance. Now there is another important concept which is not that famous in India right now, but then yes, it is gearing up as the time goes. That is reinsurance. Now what is reinsurance, friends? Now let's say if an insurer has insured a venture in which the risk involved is beyond his capacity, he may insure the same risk either wholly or partially with other insurers. So let me say there is an insurance company, right, which has covered an insurance, an insurance for Mr. A, right? But then what they feel is that the risk involved is pretty high. Let's say the risk which is involved in case of covering Mr. A is pretty high, and they are not able to cope up with that risk, or the risk exposure is pretty high at their level. What will they do is they will pass on the risk to another company, right? So they are going to pass on the risk of Mr. A to another company, right? That is called as reinsurance. So reinsurance basically shifting my risk which is being held by one insurance company to another company. It can be done partially or wholly, depending on what exposure it is and what is the capacity of that insurance company. The reinsurance can be resorted to all kinds of insurance, whether it is life, property, whether it is fire, marine, any type of insurance that takes place can have a reinsurance done. The insurer has an insurable interest in the subject matter insured to the extent of the amount insured by him, because a contract of reinsurance is also called a contract of indemnity. Now what is indemnity? It is making good the loss. So any loss that occurs to the property, right, there has to be an insurable interest by this insurance company also. So the subject matter here is Mr. A. The life of Mr. A is the subject matter, wherein insurance company is trying to protect that risk. So any insurance which they would like to pass on to another insurance company, that is through reinsurance, can be done. The insurer has an insurable interest in the subject matter. So as I said, the insurance company, firstly the insurer has to have an insurable interest, and then the insurance company also has certain interest in the risk exposure of the insurer, right? And this is a contract of indemnity wherein we are trying to cover the loss.